portion of the call. This is what kind of say. Absolutely, I sell waterfront property. 1.5 million, I think we'll be able to find something. Fantastic. Tuesday. Okay, Wednesday afternoon. Fantastic. We'll see you at my office. Now, my office was in Plantation, Florida, and one of the unique things when you were in Florida, you can actually go Palm Beach all the way to Monroe County. You got access to the whole MLS. And she got off the phone and she was bragging. She was going, $1.5 million buyer, buying in Key Largo, on the water. We're going to get together on Wednesday and we're going to go. What I'm going to share with you is an actual true story. That day came, Connie went to Plantation. The chap went there. They drove to Key Largo. They went to the first house. The guy said, I don't like it. See you later. Literally walked out of the car, used Connie as a taxi. Literally a taxi. So the reality is a lot of people want to buy. A lot of people will use you. But remember, make sure the people you're working with have the ability to buy. That's one thing. So was this guy ready to buy? The answer is yes. But being ready, willing is not all it needs to be. Buyer needs to be able. Now listen, I know you got this whole Zillow thing in the whole 9 yards, jump in the car and the whole 9 yards. It is what it is. But if it's not a Zillow, you have to decide how you want to run your business. Do you want to work with just the ready and willing, or do you want to work with the ready, willing, and able? Now listen, I want to go back to this word ready because I want to explain what it means so everybody knows. In case you didn't realize, you have to have a job. Don't have a job, there's no income, you can't get it. How much does somebody get me?
But Kevin, I'm putting 80% down.
Okay, well, okay, great. You need to have a
I need a
job.
mortgage? Okay.
You need to have a job, put 80% down.
Disability.
Disability is a job,
Okay.
right? I'm just indicating to you real quick, if a client is moving from New York to here, is it relocating with their current job? What are you doing for work? Otherwise, it becomes a second home, things of that nature. But again, you need to have a job. Now, how much do you need to make? First thing that you guys don't realize, the client is always going to tell you what they make after tax. In the mortgage world, we count the first dollar they make at a gross level. Why do you think we count the gross level in the mortgage world? Wow, silence, crickets. Because mortgage interest is tax deductible. So that's why we get the growth number. How much do you have to make? Here's a general rule. If you make 50 cents, you have to make 50. So if you make $1, you can spend 50 cents and get a mortgage back. Make sense? So the second biggest fault that people make, oh, James, I got $150,000 worth of student loans. Are you a doctor? No, I'm a barista. Okay, great. So listen, the person that has the $150,000 loan, it's not what they owe, it's what their monthly payment is. It's not what they owe, it's what their monthly payments. I have $7,000 for the credit cards. Great. Hope you did something super for that real quick. But I'm only worried about the $150 worth of minimum payments on the credit cards. Make sense? So recap, need a job, disability, social security, that's a job. Do you know somebody is age 55 or older? And don't have a job, but they have a 401k program, we can make their 401k income. Right? So the reality is, but as a general rule, you're talking to that person, they don't have a job, they're not going to be able to get a mortgage. So we're to talk about mortgage rates at a very high level, very high level. Listen, a lot of people think mortgage rates live in the stock market. Who thinks that? Anybody? Great. How about the Federal Reserve? Do you guys think they set the mortgage rates? Go ahead.
I know they don't.
Okay, they don't.
but
Right.
I know they.
They do. But I want you to think about this. The Fed does the beat, but not the dance. Okay, so they kind of set the tone, but not the thing. The one thing we're going to find is this. So right now, as we're talking right now, the Fed is meeting at 2 o'clock. They're going to say that they're not going to do anything. That's what my opinion is. big mistake, but I'm not the Fed guy. The reality is customers will assume that just because the Fed drops, that mortgage rates drop. They do not. You got to set that expectation with people and things of that nature, because if you're working with a seller, they're going to call you up and say, well, God bless it, Sharon, mortgage rates dropped 0.5%. Fed Powell said they're now 4%. The rate that the rate that the Fed talks about is what banks can charge other banks for overnight money, because there's some reserve requirements and how much money they have every night in the bank. And remember, the Fed doesn't care about mortgage rates. What the Fed cares about is full employment and no inflation. They don't care about that, but they do kind of set the tone for the market. But here's the thing, mortgage rates live in the bond market. And the bond market is forward thinking. So quite honestly, if the Fed was going to make a move today, the bond market would already know about it and rates would be already better. But they're not, because the Fed isn't going to move. The only thing I want to talk at a very high level real quick is bonds are counterintuitive. When bond prices go down, yield goes up. When yield goes up, rates go up, and vice versa. When bond prices go up, yield goes down, mortgage rates go down. So what changes these things real quick? Is the economic health, supply and demand, news, government intervention. Some of you don't remember government intervention. You heard of quantitative easing. That would be an example. And the technicals. I look at the technicals to determine when to lock somebody's loan and when not to lock. But we're talking about rates. Let's just do this real quick. I'm going to go ahead and go like this. Okay? One second here. So mortgage rates are going to get better. It's not a question of, it's just a question of when. Now, I personally think that mortgage rates are probably going to get better probably by summer or fall of 26. And I think that we probably have the potential to look at a 5.75 rate. But this is the actual forecast that we're going to quarter 2026. When I did this real quick, you'll notice that I'm over here, Fannie Mae's there, whole 9 yards. So I believe that this number is a little bit is a little bit split forward back. Oh, remember that Min is in the house, everybody. Uncle Sam will help pay your mortgage, however, he won't pay your rent. Make sense? Mm-hmm. One of the most successful things that you can do is not care about the outcome when you're talking with a client and not have commission breath. Not everybody will be able to do a mortgage interest deduction off their tax returns. Not everybody will be able to go ahead and write off their state and local taxes because they don't itemize. But I think it's our obligation, duty, and responsibility to explain that ability to do it. For example, Ben, I'm gonna use you as a question real quick. When you're talking to a wannabe brand new investor, I almost guarantee one of the benefits you're talking about investment properties is this. Your income comes in at a passive rate. You get to depreciate the property over 27.5 years. You get the appreciation of the property. The fact of the matter is, I think it's our obligation, duty, and responsibility to share all the features and benefits of home ownership, because there's more financial than just brick and mortar. It's more than having the perfect thing. Our job is to get their emotional side as well as their financial side up there real quick. If you go ahead and just Google mortgage interest, when mortgage interest is tax deductible, you'll see here real quick. But this is a benchmark real quick. There's a video. You'll find ads on it. And if you're in the car, listen to it. And so you know it. You'll learn the scripts. But listen, if somebody is at 7%, their real rate's only 5.32% if they actually itemize their taxes. And then a 24% tax bracket. Guess what? That doesn't happen when you rent. Uncle Sam doesn't care if you rent. So if you're on the Instagram, who is on the Instagram? Anyone say yes? Great. Take a picture of this if you be following me. I'm gonna wait while everybody gets their cameras out, just so you know, real quick.
Oh,
Okay,
my
thank you for
God,
your
you.
real quick. You're not on the Instagram?
The Instagram.
Here's the thing, real quick. Whatever I have with you, what? Use it. And I'm not bragging, I am telling the truth. Go on social media, all platforms help one person every day. We help 3. I'm not saying I do a deal a day, but we get at least 3 DMs through our social channels, help people. So I know that my content's there. We're not there for likes, we're not there for views. I'm there to show up for that one person, develop a relationship. Because the reality is, the time somebody raises their hand to actually buy a house is 18 months. I'm gonna be in the business for a while. So I'm okay with that. So let's talk mortgages real quick. You got something called agency, conforming, or conventional. Guess what? All 3 of those, exact same thing, also known as Fannie Mae, Freddie Mac. Then you have the government loans, the FHA, the VA, not Virginia, VA, Veterans Administration, and the Rural Development Loan, also known as the USDA. You have then something called jumbo loans. And then you have something called non-qualified mortgages. So amazing was at a very big team in the Triangle in Johnson County. Person would be kind of like, if I said it to Sharon who it was, I will go with, I'm gonna share it and see if she's surprised. Her team had no idea what a non-qualified mortgage was. She had no idea what a DSCR loan was. Nobody on her team was.
What is it, Kevin?
Okay, well, we'll get back to it. But I'm indicating to you, by you guys being here, even if you know it and it's refreshing you, it's important, because here's the thing. There are, I would consider a great agent, fair statement. You know, don't sound too optimistic, but she's a great agent, but not staying in tune with what the market is to help her client. So here's the punchline. Let's talk Fannie Mae and Freddie Mac. And you're wondering, why do they use this term conforming, you say? Okay, anybody know? Bueller? They use the term conforming because the loan conform to Fannie Mae and Freddie Mac rules. Now, all loans have written guidelines. What are they called? Guidelines. They're not hard and fast rules, so guidelines are subject to interpretation. We're going to use a baseball field as an illustration. In the guidelines, if the ball is hit right here, is it in or out for all you baseball fans? Okay. If the ball is hit right here, it's out, right? If the ball is hit here, it's in. If the ball is hit over here, it's out of the park, but anyway, but it goes here. So if the ball is located on the field, that means, according to the guidelines, it can be done. Now, I'm a direct lender. That also for Fannie, FHA, VA, whole 9 yards. That means I close all the loans with my own money, and I make all the decisions. So unlike major companies, what they do is they shorten the field. And even though the ball might be hit over here, the answer is no, because it doesn't fit into their thing. Even though it fits into Fannie Mae guidelines, they say no to that scenario real quick. So case in point, he is not here today, but there's somebody sent me a deal. Zillow said no. I said yes, because the person was a non-permanent resident. And Zillow only looked at one product and said no. I said yes, because I'm not playing in a shortened field, I'm playing on the entire field. And that's the difference between you getting 1 or 2 more deals versus no deals. Now, conforming limits change every year. There's 100 counties in North Carolina. These are what they are. Notice that you can buy a quadplex with 3% or 5% down. You can buy a duplex with 3% down. You can buy a single family house for $800,000 with 3% down. The reason that I'm sharing that with you real quick is number one, you're talking to somebody from California, their conforming loan limits are going to be materially higher. The first conversation you're going to have, what talk to the person in Florida, the county they're moving to is 850. The reality is the conforming loan limits change. But just think about this. 20 years ago, this was 50% less, right? 400, was it 417?
Forever 417.
417. So the reality is we can buy more house and with more.
So you guys know that if it goes over that 800, that's where you get the jumbo ones, and that's like a whole nother layer of what's required.
Okay, but remember, loan limit, not purchase price, loan limit. Make sense? Now, the minimum credit score is 620. Can I use you guys for a second here real quick because you're married, right? Let's assume that she has a 600 and he has a 640. We can qualify him because we can use what's called a blended score and it becomes 620. Make sense? Okay. Not everybody knows this, just so you know. I hate to say it real quick. This is an art, not a science, and the reality is there.
Question,
Yes, ma'am.
for a blended score, does it have to be like a spouse or just both people on the loan?
Both borrowers. Both borrowers.
Could be like a parent and a child.
Down payment as low as 3%. Now, listen, when you put 20% down, you don't have to pay something called PMI, private mortgage insurance. But here's the thing real quick. There's an agent in the triangle that will not work with any client and not let any client buy a house without 20% down. Because it's her moral obligation to make sure that's the case. Stupid, just so you know real quick. PMI is not a bad thing. It's not an animal coming out to fight people. PMI is a tool that allows somebody to buy a house with less than 20%. In the conventional world, PMI can go away. So you know. So it's not a bad thing. There's something called level loan price adjustments. Has anybody heard of that? Okay. So here's the thing. Have you ever wondered why one client gets a rate of 8% and another client gets a rate of 6.25? Well, let me just tell you this. There are 9 pages of adjustments that determine what somebody's rate is ultimately going to be. So let's kind of explain this real quick. Very high level. Again, don't want you to be mastery, but I want you to do it. So let's assume that I'm getting a loan and I have a 620 or 640 credit score. Okay. And I'm putting 20% down. And let's assume that Sharon's buying the exact same house, my neighbor, and she has an 800 credit score. We both could have the exact same rate if I wanted to pay 1.875 points. Because that's how much more expensive this is compared to where Sharon is. Make sense? Now, the challenge is that this means that if Sharon has a rate of 6, and I don't want to pay these points, I'm most likely going to have a rate of 7 and an 8. Or I could get the same rate that Sharon has with the 800 credit score and pay the 2.25 points. But generally, when somebody has a credit score in the 640, they don't have the 2.5 to pay those points to get it done. So the reason why it's that way is that. The second thing is, let's assume same scenario, but let's use Sharon for an example. Sharon's buying an investment property with 20% down, 780 credit score. Well, you just told me that Sharon was getting a rate of whatever I said, 6.25. But now what I'm going to tell you is you have to have the adjustment on the equation right here, and it's 3.375 points for an investment property. So now Sharon's rate is closer to 8% unless he wants to pay those points. Right? Now, let's assume, I don't know why she would do this real quick, but let's assume she wants to do it. She wants to put 20% down by an investment property that also is a manufactured home. So now we gotta put this adjustment on top of that real quick. So the reality is there's a lot of factors that determines what somebody's rate. So when that client says to you, hey, Vicky, my friend just got a rate of 6.25. Great, there's a lot of factors that determine it, and that's the difference. Saying that your friend either paid points or your friend has like an amazing credit score or both. Yes, ma'am.
I feel like this existing, but I haven't seen the chart.
Yeah.
So how often does this situation happen?
So this is the previous administration changed this, so it hasn't changed for a while. I think so I'm gonna so I actually sent a letter to. Great news. Can I give you some great news? A friend of mine is now on the board of Fannie Mae, right? He's paid $160,000 a year to be on board. Anyway, I wrote a letter to him and I said, hey, listen, you want mortgage rates to drop tonight? Get rid of your level loan price adjustments and boost the market. So this has been up to the most recent change, it was stagnant for a while, right?
Well, that's where the second homes then went up.
Yes,
Part of the-
the second homes.
Yeah.
There was so much occupancy fraud, so second home is priced exactly the same. But the big mistake here is real quick, if you notice this real quick. Somebody who has a 760 credit score. And is only putting 5% down. Or let me go here real quick, someone has a 740 to 759 credit score, putting 5. It's sometimes better, you'll say, Kevin, why are you telling the person to put less money down? Because look, there's less of a price adjustment here. So the reality is, it's a lot of things. Now, one thing that's not used very often is interested party contributions, also known as seller concession. Let me explain something to you real quick. A lot of buyers have the down payment. They don't have the closing cost. So remember that if they're buying a house, the seller concession cannot exceed 3% of the purchase price if they're only putting 10% down. If they're putting 6% down, if they're putting 25 to 90%, they got 6%, 75 less there. If it's an investment property, the maximum seller concessions are 2%. Remember, seller concessions are based on purchase price, not loan amount. So, in other words, if Sharon's buying a property for an investment property for $300,000, put $100,000 down, it's $6,000, not $4,000. Make sense? Gift funds, ever heard of them? Okay, the term gift is a mortgage term, not an IRS term. Unless somebody really has an estate more than $14-15 million, there's really no tax implications to giving a gift. Any tax liability is on the donor, not the recipient. Make sense? So in other words, your buyer getting a gift has zero tax liability. The only person that would have any concern about it would ultimately be the actual person giving the gift. So a gift has to be from a spouse, a child, or other dependent, or by any individual who's related to the borrower by blood, marriage, adoption, or a legal guardianship, or a non-relative that shares a family relationship, things of that nature. So the reality is an aunt, an uncle, fiance. Those were the gifts. All that the gift document is going to say is this. Ricardo, you're giving me a gift for this amount of money, and there's no obligation Kevin has to pay Ricardo back. That is all the gift document is. I want to make sure that you understand it's not that complicated. All that we're trying to do in a gift document is this. There's no back end deal that you have to pay the money back. Sadly, U.S. real estate agents cannot give a gift. Now I'm going to talk about one of my our most popular program right now. Family helping family. Anybody hear about this? Okay. So let's assume Kelly's my mom. And Kelly is only making Social Security. Vicky, you have a client like this. Yes, you do. Now, she only makes Social Security of how much you want to make Social Security?
800 a month. It's not much.
You're doing well, Grandma. But you know what? I want my mom to be close to me. You know that I can buy a house with as little as 5% down. How much down?
5%.
Okay, can't do 3, can only do 5, right? Minimum 5, do 20, do more. You can buy a house as a primary residence for my mom, Kelly, with 5% down. Not have to live in the house. Mom doesn't have to be on the deed. All I need to get is mom's Social Security award letter to prove that she only makes $800 a month and can't afford house fires. Why is it significant real quick? Then if I do this, Kelly, here's the advantage to this real quick. Guess what? I get to treat this as a piece of investment property on my tax returns. I get to depreciate over 27 and a half years. I get to bury my landscaper and things of that nature into that. Plus I give mom a great place to live. It's called something on the family opportunity. Check it out in the whole 9 yards.
Does she have to live there?
Mom has to live there. Great question. Now you're ruining it for everybody, you know. Wow. Well, but so I have a client in Florida that we're doing this program for. I truly do not know if the parents ever gonna live there. But the reality is, as long as they tell me that, that's great. Listen, I want to talk buy down here, and I want everybody to just read this silently and tell me what you think about this. Read this silently and tell me what you think about this. Have you ever thought about it? Man, what's your name? I've never seen you here. Well, you know me. Yeah. Okay, great. You ever thought of it? Okay. A mortgage rate buy down gives the buyer more monthly payment relief per dollar than a price cut. Wait, does that make sense to everybody?
Mhm.
The price is irrelevant. It's the cost that matters at the end of the day. So everybody knows what buy downs are? Let's say no.
No.
Okay, great. A buy down comes in multiple flavors, just like Baskin Robbins, 31 flavors. By the way, do you know that Dunkin' Donuts changed their name to Dunkin'? I mean, 7. All right. It comes in multiple flavors. It has a 1-0, it has a 1-1, has a 2-1, has a 3-2-1. A 3-2-1 is like finding a leprechaun riding a unicorn on 440. Never happens. Okay. A 2-1 is like just finding a 4-leaf clover and then a leprechaun picking it. But the most popular is a 1-0 and a 1-1. So if the start rate is 7, the first year rate is 6. Then after the first year, the rate becomes 7 for year 2 through year 30. A 2-1, similar thing. If the start rate is 7, Jeannie, let's do some math together. Ready? That means the first year is 2% less. That means that rate is, that's correct. The second year, the rate is 6. And then it's 7 for every year they're at. Now, this costs about 1% of the loan amount. This costs about 2.5% of the loan amount. That's okay. So it's a $100,000 loan, which I can't do a $100,000 loan, but it was a $100,000 loan, about $2,500. Now, in this example, a $400,000 down, 20% down, a 30-year fix at 7%. This is principal and interest only. This is only for illustration. This is not a thing. So, first year they save $411. Second year, $210. Year 3 through 30, maybe even more. The reason why, we're probably going to refinance that. Now, one thing that you have to understand, and it doesn't matter I'm not the lender. Sad if I'm not, but if I'm not the lender, want to make sure you know this. Your client, all their loan documents are going to show the rate of 7%. How a buy down works is very simple. The buy down amount gets put into a custodial escrow account. So every month, what happens, they'll pay that lower payment and a portion from that custodial escrow account gets paid to pay the different thing. So the loan is actually amortizing at 7%. Make sense? So just want to make sure that you know that. The other thing that I think is missed by everybody on buyouts, it's a quasi asset. So let's go to Sharon again here real quick. Sharon buys a house on Monday. James has negotiated a 2-1 buy down on a $400,000 loan. Okay, what does a buy down cost? 2.5%. So what's that? $10,000? Okay. Now let's assume on Tuesday, Sharon decides to move to Minneapolis, or rates drop 74% and now it's 3%, just like it was during COVID, and we refinance. That proration of that $10,000 is refunded as a principal reduction on her loan. So that $400,000 house, when we go and refinance it, if it happens the next day, it only owes $390. Make sense?
Mhm.
Now remember, the interested party contributions or the IPCs, they all apply. Yes, ma'am. Did you have a question or just saying, hey, Kevin, hi, I'm married? Is that what that was? Because you went like this with the ring, right? Did you want them to get this why we're doing this or no? All right. So let's talk about FHA. Fun fact, real quick. FHA is the only self-funded government entity. In other words, they make all their own money. Number two, do you know the reason we got out of the Great Depression was because of the FHA loan? Because before then, you had to put a fortune down to buy a house and the terms were very low. Now, FHA has county limits. They change every year. And Jeannie, I want to make sure I made this clear. The loan limits change annually about Thanksgiving time. Level loan price adjustments are pretty stagnant, right? Type of stuff. But in Yoho and Wake County, the limits all depend here based on whether it's a 1-unit, duplex, triplex, quadplex. So yes, you can buy with an FHA loan with only 3.5% down a quadplex for $1 million. And by the way, well, my client can't qualify for it. By the way, when you're buying a duplex, triplex, quadplex, we get the appraiser to tell us what those other properties will rent for, and we use them as effective income for your borrower. Make sense? In the Durham and the Orange County, you like how I call it Durham? Notice that the loan amounts are higher in Durham as compared to Wake and Johnson. 632, 809, $1.2 million. Now, down payment's 3.5%. You put 5%, you get a little bit less expensive mortgage insurance. But here, let me explain this to you. Everybody wants to do it because this is a perception. You know how you have people say, well, I got to put 20% down. The second biggest perception is FHA is only for first-time home buyers. You don't have to be a first-time home buyer, you can be a repeat home buyer. The interested party contribution or concession is 6% on an FHA based on purchase price, not loan amount. And with FHA, it's like driving in England. In England, they don't drive on the wrong side of the road, they drive on a different side of the road. So there's an upfront mortgage insurance premium. It's 1.75%. It's financed into the loan. It is not a cash event. And then there's a monthly mortgage insurance premium that is there for the life of the loan. In other words, unlike a conventional loan where PMI goes away, guess what? This is here for you forever. Okay. Now, I'm going to do the math here. The $100,000 house, you got to put how much down with an FHA loan? 3.5%. That's $3,500. $96,500 is the base loan amount. You got to add the upfront mortgage insurance, $98,189. Make sense? Because here's the call that you're going to get. Here's a call I'm gonna get. Here's the call I get a lot. Hey, Kevin. From the real estate agent. When they see the closing disclosure. Why is their loan amount not 96,500? Well, remember that there's upfront mortgage. Yes, you can use gift funds from a family member, down payment and settlement costs for this. And again, the IPC 6%. This is my second most popular program, and by the way, not trying to brag, but I do a lot of loans. The no down payment FHA loan. Now, I had a client of James. That was buying the duplex, because you can use the program with the duplex. I did not win the loan. I'm gonna be transparent with you real quick. I was trying to convince the client to do this. If she would have been in the house, I don't know if you remember the client I'm talking about. She would have bought with this house with an FHA loan, had a payment that was $200 more expensive, but she would have $25,000. And that means $25,000 more, which she then could have gone ahead in 12 months, bought another house. And complete her investment portfolio. But this is exactly what it sounds like. If you're buying $100,000 house, you get $100,000 first mortgage. Second mortgage for $3,500. Sometimes it's forgivable, sometimes it's not. Credit score can be 600. You get the closing costs. I have one client bought a place. It's not Littleton, it's Lillington.
Lillington.
Yeah, there.
Angie.
She was paying $1,800 in rent. She was in the house for less than $750 with no down payment. And a mortgage is exactly the same. No down payment FHA loan. Very, very powerful. So here's the script real quick. Ring, ring, Kelly. You can be a client wants to buy a house. You have no money. Go. Ring, ring.
Hello.
Oh, I'm calling you. I'm sorry. Hey, Kelly. This is Kevin. Hey, listen, I saw you online and hey, what's making you look at houses today?
Well, I just was trying to get out of this place that I'm in and get something that's just my own.
Wow, you have a great country accent, don't you, Kelly? Thanks for asking. Hey, Kelly, so let me ask you this question. How much do you pay for rent today?
$429.
$429. And let me ask you this question. How long have you been renting?
12 years.
So you, in other words, you've been paying your landlord's mortgage for 12 years.
Yes,
Well, I think it's time that we change that, Kelly, if that's okay with you.
I would love that.
So let me ask you this question. If I can get you something close to what you're paying today with a very little down payment, would that be something that'd be interested to you? And with the knowledge that you are gonna be a homeowner?
I've heard that would be very good for me, but how much of a down payment?
Well, I don't know exactly. What I'd like you to do is have just a conversation with my mortgage partner, Kevin. He's very good at what he does. And just so you know, there's some very innovative programs out there. All fixed rate mortgages by, just so you know. So this way you have the safety and stability of knowing what your rate's gonna be all the time. Would you be open-minded to have a brief conversation with Kevin?
Sure.
Fantastic. That's the punchline. You guys get the flavor. I'm not gonna do the script. The reality is, we sell stuff that people don't wanna buy. 80% of millennials think now's a shitty time to buy a house. Our job is to make it sex. Believe with an open heart, and if you all don't believe it, then you should get out of this business. If you want to create generational wealth, you need to own real estate. You need to believe that. I believe that. I know it because it's easier to make $1 million in real estate than it is in a job. And you got to get that passion out when you're talking on the phone. And no, you don't need to know the ins and outs of the no down payment program or the ins and out of family helping family. What you need to know is just enough sound bites, hook, and give them to me to help you out. Drum roll, please. Brand new product, just bringing it out here, is a 203K limited. Okay, an FHA 203K limited. So essentially, here's what we're gonna do. You ever been to a house that had a Brady Bunch kitchen and had a terrible bathroom? How about need some interior paint and roof repair? We can finance up to $75,000 of this into the loan. And the repair and the appraisal can be subject to and still close. So in other words, a little minor, no investor, sorry,
Yeah.
but the reality is FHA, but the reality is a great program right now for some people, some challenges here real quick. Say that she has a house, has carpets, terrible, right? You walk into it. We can go ahead and I'll just do a new carpet, paid after closing, installed after closing, and go that way. Huge profit, huge profit. Gotta get more thing. Maybe I did a bad job explaining it, but anyway, we will know. Has to be licensed contractor, but if it's great question, thanks for playing. So the reality is this, if it's like a carpet vendor, things of that nature, we'll pay them directly, we gotta get a bid before closing. Same thing with the contract. But HVAC replacement, how many times do you have that into real quick? Major investment, well, 9 yards. Now, we can't do structural, we can't do add-on, because this is a minor. By the way, major, this is major, because this just changed about a month ago. You used to only do like $10,000, so I didn't even bother doing it. Now it's 75, makes it significant. Now, the VA, I'm sorry, here you go. Wait a minute. I got your back, don't worry about that. You're welcome. So, Department of Veteran Affairs, first off, great program. 100% financing, no loan limit, no mortgage insurance. You want to know who to sell this to. Anyone you see that's wearing a uniform would be a great opportunity to sell it to. Number two, I have found that 1 out of 2 soldiers, airmen, Marines, sailors even know about this benefit. Coast Guard. You can use a VA loan more than once. I am doing a loan for a client that, guess what, is now, right now, has 2, and he's getting his 3rd, using something called bonus entitlement, all 100% financing. VA loans have something called a funding fee. However, that funding fee is financing the loan, and sometimes it varies based on where they are, and the maximum seller concession is 4%. So if it's their first time using it, the funding fee is 2.3%. If they're using it more than once, it's 3.3. If they have any level of disability, you have a client right now with a disability with a VA loan, and he has no funding fee. Okay.
Their kids use it.
No. However, if you're a soldier and you pass away, your wife has the benefit. Surviving spouse.
Oh. And in a VA loan, they have to be married.
Yes, great question. So both people have to be married, yes. Well, you can be living in sin with somebody that just can't be in the morgue. Does it make sense? Okay. Listen, this is an underrated program because here's the thing real quick. When you do one VA loan, I think you'll probably end up doing 2 or 3, and the lead source will always be the same person. Because these people chit chat all day long. And the reality is, if you do a great job, they're going to tell your friends, family, and everybody they know about it real quick. VA loan, great profit. Subsidized rate. No loan limit. Let me explain that to you one more time. No loan limit. So the conforming loan limit is $800,650. There's no conforming loan limit. If you can qualify for $4 million, you're getting 100% financing with the Department of Veteran Affairs. The rural development home loan. All right, so you can't see this very well. This is mustard. This is not mustard. What is this? Mustard. This is. So if it's in the not mustard area, it is 100% eligible for 100% financing with the rural development home loan. The income limits for a family of 4, you can't make more than $140,500. Now, that family of 4, let's assume that Stephanie and I are married and we have two kids, one's 17 and one is how old? Doesn't matter. But that 17-year-old works at Burger King and is living in my roof. Even though that person is not on the loan, our income cannot go over 140,500 to include our child that works at Burger King.
Hmm.
That's income limits
That's
for
weird.
everybody who's living in the house.
That's the day you apply and get accepted. What if 2 months later he gets his Burger King?
After we close, I don't care.
Nobody's gonna come back.
So let's assume my mom Kelly's gonna live in the house and she gets social security of $850 every month, I think it was, right? I have to count that, not for qualifying, but for program eligibility. Number two, if it's 5 or more, goes up to 185. Now, very strict on guidelines. There's two ratios you need to know, but not really, but I'm gonna share them with you. There's something called the housing ratio. And that's where we take what your housing is, divide it into your gross income. And why do we use gross income again? Thank you. So the reality is this. If my income is $1,000 a month gross, and my housing payment is $290, that means my housing ratio is 29%. Since 1,000 and that one. They want to keep this around 31%. Number two, the back end ratio is about 43%. Now, even a note from my mom will help somebody who has a higher ratio than that get loan approved. By the way, they're moving a major office of the USDA right here to downtown Raleigh. They're moving out of Washington. Jumbo loans, jumbo. So I don't want to call this the Wild West, but I'm going to call it the Wild West. So I have a client that with a jumbo loan, minimum down payment is how much?
20%.
20%, you want to say, give me another answer, 25, 10.01%. Can I tell you something nice about jumbo loan? Say what? Okay, that didn't sound very enthusiastic, say it again.
What?
Okay, no mortgage insurance at that 10.01%.
Hmm.
Now, obviously, listen, there's no such thing as a free line. You want a better deal, you put 20%, you put 15% down, the whole 9 yards. But jumbo has a 10.01, no idea why it's 10.01, it just is what it is. Next layer down is 15%, next layer down is 25% or 20%. So the reality is a great program. Generally starts capping out about $3 million per loan amount, then it becomes a super jumbo, then you gotta put larger amounts down. But jumbo loans, don't be afraid of them. But sometimes we can avoid them because we slice and dice the mortgage into a first and a second mortgage. That's another class on its own merit real quick. Want to talk about non-QM mortgages. You know what QM stands? Okay, did you have any questions about jumbo? And how much down? 10.1. I appreciate you coming out with 20%. You thought you had the winning answer. You didn't. You are the loser today on that. Okay, real quick. All right. Non-QM mortgages, real quick. I want to talk about it. QM stands for qualified mortgage. So first off, my favorite property, and let me also make sure everybody understands. These aren't expensive, but they ain't cheap. Let me say it one more time. So let's assume the going rate is 6.5. The DSCR was what, 7.5, right? So you're paying a point and a half more, right? So a debt service coverage ratio, often known as DSCR. Here's how it works real quick. We don't look at your pay stubs. We don't look at your tax returns. We do look at your bank statement to make sure you have your down payment, because guess what? 100% of the money for your down payment has to come from you, and not the exec. We then get the appraiser. We say, hey, appraiser, what's this house going to appraise for? If the appraiser says the house is going to appraise for what the principal, interest, tax, insurance, and HOA is, approved. If the payment equals the mortgage payment, approved. I gotta say it one more time. If the payment equals with the mortgage payment, what you can rent the house for,
Yeah, that's part we looked at, what it would
Yeah.
rent
what
for.
it will rent for. So you have a $2,000 replacement rent for 2,000, the mortgage payment's 2,000, that's what approved. With no income down.
The PITI or just?
PITI.
And HOA.
Management, okay. There are programs. That might allow some things, but generally speaking. That might allow a little bit less of a ratio, but then it gets really, really, really expensive.
Credit report,
640.
640.
640. By the way, cannot do manufactured homes. I know. Maybe in the crevices of the internet, there's somebody that can do manufactured homes. I have never found one, but I don't really think manufactured homes are a good investment. Not saying there's anything wrong with them manufactured. Okay, I'm gonna keep moving forward. Bank statements, 10% down. Primary residence, might be even investment property if you want to do it real quick. So here's how it works real quick. We're gonna take the bank statements for the last 12 months. We're gonna add up all the deposits. We're gonna put a factor of 50%. So in other words, if we add up all the bank statements and say they average out to be, they total $120,000 deposit. We divide that by 12, that's $10,000. And we're gonna take 50% of that, and that's what your income is. Unless you have an accountant that tells us what your expense ratio is. And if an accountant says 15%, most accountants will say it. And when they do say it, then your income is now $8,500. So, just because you have a atypical client with an atypical job, you have bank statement out.
Even without 2 years, if they're self-employed,
You have to be self-employed at least 1 year,
okay.
and but you have to have a CPA,
Okay. CPA, 1 year, 10%, credit score.
660. Better, remember, all these products have behind the scenes, those level loan price adjustments type of situation, so I'm giving you the bottom line there. I-10 is, you all know what it is, right? So if you're not legal in the country, you go ahead and get a tax ID number, which happens to be the exact same digits as your social security number. And that has become your social security number. We get a credit report and 20% down here is what's needed for this. And use whatever your normal income is. Lot of people, lot of opportunity in this. So those are just 3. Every day it seems like another one's gonna come out. But the reality is it's you need to know it's there so you can actually go ahead and help more people. Credit, pretty simple. Bad things happen to good people. Just because bad things happen doesn't mean they're not great referral sources. So if you get a call from James, gets called, and says, why did you declare bankruptcy? Well, guess what? In 2 years, that person will buy a house. But really what James should ask is, why did you, listen, I want to be personal, was it, are you okay? Was it a medical reason that you went bankrupt? Or was it some, yeah, I had cancer, I survived. Well, then it's 1 year. The reality is this. You know, in the mortgage business, I don't know what it is for you guys, maybe you guys know. 78% of buyers will do business with the first lender that they talk to. And I almost guarantee you that if you're working with somebody that's 100% that you nurture over this, you're gonna be in this long term, these will become the biggest referrals for you ever. But just so you know, negative events happen, they don't define it real quick. Also want to let you know there's a difference between what people. Did you know free credit, what's it called, Credit Karma sucks, right? It doesn't suck, no. You know that every industry has its own different model. Right? So if you go to Credit Karma and they're not putting a weighted factor on all the other accounts, they're just doing a general screening. You know, if you went to a car dealership, credit card company and a mortgage company will always have different credit score. because the mortgage company is putting a weighted factor onto things real quick. I want to talk about this because this is big. Bill Pulte, who runs the FHA, this is coming and it's gonna help 4 million more people. So right now, we're used to using the FICO model. Soon, we're waiting for 5 million more people to be able to do it. Where with the Vantage score, which is coming, which is so significant, is in the FICO model, if you pay off a collection, the collection still counts against you. Make sense? In the model. In this, when you pay off the collection, it doesn't count. It's almost erased. Number two, some people do some self-reporting. Right now in the model for FICO, self-reporting doesn't count. However, self-reporting will count this real quick. So a lot more people, as this starts to get there, it's been a mandate that's come out. So the reality is keep this top of mind. Want to go here real quick. I think we talked about this a couple weeks ago. So remember, mortgage interest is paid in arrears. So if this is we're closing on May 19th, remember this. On May 19th, you're paying interest from the 19th to the end of the month. You're not going to have any payment in June. In July, you're actually paying your June mortgage interest. Make sense?
Mhm.
This mortgage payments are due on the 1st, not past due as long as payments reached by the 15th. Use that to your advantage. This morning in Fayetteville, excuse me, in Fayetteville, we won a deal that said that we're going to close by the, I think it was the 9th or 10th, I don't remember the date. And part of the pitch was you as a seller don't have to make another payment. So accept their offer and you don't have to make an August payment. So the reality is by just structuring the date appropriately, unless you communicate it to the other agent why you're doing it that way, that other agent can't communicate that the seller doesn't have to make another payment and made our offer better. Make sense? Remember that home buyers buy based on payment, not price. Here's a question. Do you have any idea how much this house costs?
So where it is.
Mhm.
Location.
Here's the thing where I want to illustrate about it. Do you have any idea how much this car costs? 50. That's right. It's irrelevant how much this costs. It's irrelevant how much this costs. Because at the end of the day, people shop based on payment. Now, when somebody says to you is this, and this is something I want to let you know. Who closed the deal in the last 7 days? Okay, great. Okay. You said 20 bucks. What did the house cost?
It costs $460.
You think it actually cost $460? I don't think the house actually cost $460. The true cost of something cannot be determined until it is sold. Does that make sense to you all? If I go and buy a boat for $400,000, I keep the boat for 3 years and sell it for $300,000. How much does the boat cost? Only $100,000. So the reality is the price tag is not what it is. When you guys are working with a seller, guess what a seller needs to worry about? What the short-term price fluctuation is. When you're working with a buyer, you need to worry about the long-term cost. And you know what? The long-term cost can really only be determined when they actually sell the house. And pre-position them real quick. Should we be the home loan first? Go find a home. And I'm going to close with this real quick because we're going here real quick. Just because somebody can doesn't mean they should, and doesn't mean they ultimately must. Let me just tell you this real quick. Today, somebody can always push a button and get a mortgage. And the reality is, so it's very easy to tell somebody they can. But just because you can, doesn't mean that you understand you should. And until you understand you should, must you do it? That's what I do. That's how I help clients. I understand the numbers outside of the scope real quick. But here's the thing, just because does that make sense to everybody? Have you ever had somebody pre-qualified didn't buy a house?
Mhm.
Listen, Jamie and I have a couple, I failed her real quick, right? So the fact of the matter is, the reality is, I don't know what the problem is. They know they can. They understand they should, but the must isn't there. So until somebody has that must, they're not gonna have it. So just because somebody comes qualified, it's fantastic, great. But understand you have to take them through the journey. One more thing, and I think that's. How was this helpful, not helpful? Didn't sound very good real quick. All right. Any questions? Yes, ma'am. We do. We do. Great question. I'm gonna go like this real quick. We do rescores, but sometimes, depending on the timing, we might not need to be able to, sometimes you don't even actually need to do it because there's other ways that we can do it and we don't have to rescore to get it done. So as it relates to credit, I'm kind of like a backwoods doctor. I know kind of general things. Sometimes I have to send the client to a cardiologist to get it taken care of. But generally speaking, we can get it done real quick. And I just do a report. I'm gonna go here real quick. Give me 1 second here because I can't find this. By the way, I wish I could blame something on this, but I can't. Over here. All right. And then I'll go here. So if you guys go ahead to either go to martinivibe.com. Don't share with anybody if you don't mind. You'll get a copy of the deck. And or you scan that thing, it'll take you right there to it. I want to kind of just got 2 more minutes to say yes or thankful for the opportunity for everybody I work with. And I don't know, so Karen, I'm gonna give that crazy lady who the kids, she was the realtor for the kids. You know what I'm talking about? Okay. I don't remember her name, but anyway, she referred me to somebody. And client said to me, I understand you're the magician. And that's because she started the story that way. And really, I was a magician for that story. But one thing is that I think that I'd like you to think about, and this is something Brian Buffini said, my lender is the anesthesiologist, I am your surgeon. That's the relationship you need to have. And I'm going to ask you to think about this for a second, this quick step. I'm not going to go into surgery with just any anesthesiologist, and here's why. I need to be able to look at someone in the eye when I present your offer, and I say, I know Kevin is going to get it closed, and Kevin is the best, and Kevin is the best at what he does. He will give you a fair price, and he's going to deliver. Kevin's not going to bait and switch you. Kevin isn't going to say whatever he can deliver you. And that's what I'm going to deliver. He's going to be upfront with you. He's going to tell you to get the documents up front. And we're going to try to make this as painless as possible. But no, there are always bumps in the road. And Kevin's the guy who's going to help you through those bumps. And I'm going to help deliver the home you want in the least traumatic way possible, so that why I only endorse Kevin. If I were purchasing a home, if my family was purchasing a home, Kevin would be the lender. I'm not asking you to use that script, but I'm telling you should. Because here's the thing real quick. Some people have cash. Let me just tell you this. Freaking envious of those people, just buying the house with cash. But not everybody does. And let me just tell you, things can go wildly, crazy, insane. But I'm not gonna, I don't wanna talk with you on this real quick. Her client, God bless it, just so you know, comes to the car, doesn't tell anybody. But we fixed the problem and we got it closed down. There.
And they weren't making tax payments too, you said.
And then.
He's like, I think I might get through this, and now they just do another one at us.
So the issue is, listen, I'm not a person, but I try very, very hard. I work harder than everybody else. And just ask for that opportunity. I want to say thank you. Can I just tell you this class sucked compared to the class on the 11th, just so you know. On the 11th, if you can be here, I think it's the 11th. It's gonna be HOT. You need to come, just so you know, real quick. What questions do you have, if any?
Learned a lot. Good.
You always are nice to say it that way. How much for a jumbo loan down?
10 to like one.
Zero one.
Zero.
Thank you. Ricardo, how many calls this week? 300. That's it. Yes, listen, I want you to think of me more as a periodontist than a dentist. I save teeth, I don't pull them. Where's your daughter? Not here today? You wanna come?
Yeah.
Okay, don't want to get involved. Long story. Sounds like a long story real quick. Awesome.
Can you do an investment?
The answer is yes,
Can you do it right now?
you can. So it probably gonna be non-warrantable, but we have outlets for all that stuff. By the way, great question on condos real quick. So ever since that terrible tragedy in Surfside in Florida. Condos, we have found, well, first off, you understand why Surfside fell apart was because the developer brought salt water in to mix the cement instead of fresh water. That's ultimately what the autopsy did there real quick. But it's also brought a light that there is a very big, what do you call it? A very big light on condos because there's been so much deferred maintenance on the properties real quick. So with that being said, condos, even for an individual, can be difficult because they might be on a no-call list, if that makes sense. They might be on a don't lend list type of situation. Very prevalent in the state of Florida, not as prevalent here, but just well, it started to become that way at the beach. They even do condo hotels. Fantastic. Listen, I think you have some announcements and stuff.
Food.
Okay, we have food, but I thought you had announcements too. Something you wanted to say about Michael Buffini?
Oh, just Mike Barry. So we'll tell you a little bit, get some food.